Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to talk about day trading and swing trading. I know a lot of people, they've got that need. They don't want to be holding on to positions. They want to get in, get out, and make a bunch of money. That's what they want to do. That is their goal. And I'm sitting here, I must have missed the whole memo or whatnot because I buy positions. I look for trends. I invest in those trends and I hold on to them for many years. So, what's the difference? How come I'm not day trading? How come I'm not swing trading? Why am I? Why did I choose the strategy that I have? So, I'm going to cover in this one day trading and swing trading and how successful they are at doing these. Most people. So, let's dive in here. I'll give you just kind of a brief overview from a couple of articles. Day trading smart or stupid? It was written in 2017. That doesn't really matter when it was written, but so coming on down here, I'm just going to kind of read a couple of things. It says, ideally, the day trader wants to end the day with no open positions, so they don't have to risk holding on to a potentially risky position overnight or for a few days. That means that if the market turns against them, they could lose a lot of money. Is this a smart way to invest, or is it just another get-rich scam for the foolhardy? So it says, do you have the stomach to day trade? If you're an amateur, you may be playing with fire. Your odds of success are like those of any other high-stakes gambler. The professionals really know their stuff. Typically, they are well-established, disciplined traders who are experts in the markets. The other characteristic is that they invest large sums of money, which they can afford to lose. That seems strange, but in fact, they need a lot of money to capitalize effectively on small price movements. The other factor is that when you trade larger positions, you are faced with reduced commissions compared to what a small stock day trader will face. They have money to risk. It is called risk capital, which is the money that they allocate for speculative purposes. This is where the high risk, high reward investment strategy comes into play. They do not bet the whole farm on one trade because they could be wrong on the wrong side of the market. There are two types of day traders: professional day traders and individual day traders. Professional day traders are people who work for large financial institutions. I think this is a great way to start. First, you will be trained by professionals and not only by a do-it-yourself online course. You may even get a mentor who will watch over you. They have all the latest tools for trading and the information on order flow and stops that are placed so that they have a leg up on the small trader. Secondly, you are not investing your own money, so you have nothing to risk except your job and your time. And then there's a trading sim states that the base salary at a New York financial institution may be about $50,000 to $7,000 US. This is just enough for you to pay your cable bill, feed yourself, and maybe take a taxi or two. They want you to be hungry and make your bonus because if you make money, it means that you have made money for them. So you should be earning about a 10 to 30% of the profits you bring in. So individual day traders, these people go it alone. Just being familiar with stocks and the market is not enough. They really need to understand technical analysis and have sophisticated tools to understand chart patterns, trading volume, and price movements. Investopedia explains that learning and understanding how these indicators work only scratches the surface of what you'll need to know to develop a personal trading style. It's important to remember that trading requires enough invested money in taking advantage of relatively small price movements. Without the price movements, you won't make money. If you are investing small amounts of money, the gains will be minuscule and may not even cover the trading commissions you will have to pay. Fiction will not cost you real money. So they talk about you trying to do it in a fictional account, basically a account that is made up, and see if you can be successful doing it. They say the success rate for day traders is estimated to be around only 10%. So 90% are losing money. It says, Corey Michael at Vantage Point Trading is even more pessimistic or realistic when he says, only 1% of day traders really make money. 1%. He says it's because of the social mood. Put simply, by definition, if you are buying, someone else must be selling. That is the social part. The markets are a real-time thermometer, buying and selling, action and reaction. If someone is making money, someone else is losing money. You would have to join the crowd as the market is moving up and be smarter than the crowd to get out before they do if it starts to fall. The reality of the day trader is a guy who got 2 hours of sleep last night because he was trying to trade the overnight session. Now he's up at 6 a.m. trying to day trade the next session. Many traders get sucked into trying to become rich day trader largely because that's what they think is socially acceptable or cool. This scenario gives me a stomach ache, which is exactly the point. I remember walking through the trading floor at Chase and hearing the moans and groans from the traders, not to mention seeing the 32-ounce bottles of Pepto-Bismol predominantly displayed on each of their desks. I know my advice. Any system of betting is not designed so that the majority of people can beat it. If you are going to dabble in day trading, set aside some money that you can afford to lose, because chances are you will. You also may want to remember the words of Aristotle, who was not a day trader, by the way. Bring your desires down to your present means. Increase them only when you increased means permit. So this guy thinks that only 1% of people who day trade are actually successful. So the majority of people, 99+%, are probably not successful at day trading. Is it worth going into day trading? It's not worth it. It's totally not worth it. I look at it and I'm like, these people are not worth it. It's not worth it. So let's go to swing trading. Is making money from swing trading too good to be true? This was written again in 2017. Making money from swing trading is possible and plenty of people do it. Nevertheless, it's estimated that 80% of people who try online trading lose money, and 95% of the people who try swing trading lose money. So we've got 95% of people who try swing trading lose money. It's estimated that 80% of people who try online trading lose money. Swing trading requires a great deal of study and practice along with strict money management and discipline. Most people aren't cut out for it. Identification. It says swing trading involves identifying stocks in a definitive trend, then making several short-term trades within that trend, entering and exiting to maximize profit. Swing traders work with price moves that last about 5 days or a bit longer. They buy on a price pullback, then ride the next swing upwards, and sell as close to the top of that wave as possible. Unlike long-term traders, they are not concerned with company fundamentals such as quarterly earnings, only with the stock chart. So warning, for most people, a longer-term system like trend trading, buying stock in a definitive trend and then holding it for several months or even years, will provide more profit than the very active swing trading. It isn't the techniques that usually trip up short-term traders, but money management difficulties combined with psychological issues. The significance. People wanting to try swing trading should only do it with money they can afford to lose. Anxious traders make bad decisions, and when people need successful trades to pay the bills, they almost invariably lose money. These types of traders become too heavily invested in wishful thinking and are unable to take small losses, thus staying in bad trades and losing even more money. They do compulsive trading during time periods when they should sit out, such as when the market is moving sideways or becoming too volatile. It says effects. People who need to be right all the time will fail at swing trading. Swing trading must be able to accept many small losses in addition to their larger successes. They must determine a specific amount of money they will risk on each trade and cut their losses at that exact point. They cannot become distracted by hope and frustration. So really what I want to talk about here are shorter term swing trading, shorter term day trading. It's not successful, guys. 95% lose in swing trading, probably more than that, and 99% lose in day trading. What makes you think that is putting the odds in your favor? That is why I will. So I know a lot of people, they want trades. They want to put on trades. They want that chase, I think. But when you look at the actual math and the statistics behind it, you're not going to be successful at trading if you're going to try to do this. I mean, yeah, you could jump on the coattails of other people who might have a higher success rate, but you're still subject to all of the discipline and psychological behaviors that you're going to need in order to successfully pull off any sort of short-term swing trading or day trading. I used to swing trade on the short term. And what I found is that I made far more money not doing it. I made money swing trading. I was one of the few percentages in here. I just didn't make as much as I'd want. And in order to increase your statistical probability of being successful, you have to change your entire time frame. Your time frames have to stretch out. They have to get much, much longer than months, weeks, months, and even years sometimes. Now, I'm trading or investing this commodity bull market. I bought pretty good entry point in 2020. I bought in very good time frames for precious metals. I bought very good time frames in some of the energy companies. And I've been adding along the way, trying my best to time my purchases on big pullbacks. So why does everyone think that they can beat the market if the statistical probabilities are so low in the short term? I gave up on the short term, guys. I gave up and said, nope, it's not that. What you need to learn is to get the correct time frames. You're going to have to be patient. That is part of the game. I'm going to say this. The game taught me the game. And the short-term stuff, it's not reliable enough. Your statistical probabilities of success are too low. And I don't like losing that amount. It's very stressful, and I don't think it's worth the stress because you're probably going to lose. So not only are you very stressed out, you're going to lose anyway on the short-term stuff. The statistical probabilities are by far not in your favor to do that. So why play the game if it's not in your favor? If you look at the more successful traders, the ones that have really extracted value out of the market for long periods of time, their time frames are super long. They're looking at investing in companies for a lifetime. And they usually choose certain companies where these companies aren't changing rapidly. They're not in technology companies. They're not in these companies that their products get manufactured or designed out. They usually choose financial, insurance, long-term transportation companies, food product companies, health insurance, medical equipment, stuff like that, where you've got these long-cycled, basically gigantic. It's basically more or less a play on the demographics of the world. That's really what it is. And they can sell more products into the market so long that those products can be consumed. So beverage companies, food companies, land companies that are producing something, so on and so on. They don't really go out of style and people don't really care. They just want to consume it. So it could be like a energy drink or soft drink or whatever it is. That's where a lot of people made a bunch of money. That is where they made the money, and they stretched out their time frames. Peter Lynch, Warren Buffett, on and on and on of all these very successful investors. Other ones have identified market conditions where the market conditions have changed, and they really hit up the trend, so to speak. So they're early trend seekers. They can identify the trend before it necessarily happens. Or they go into these really lopsided, very low risk, high reward bets that they can identify. Maybe it is investing large amounts of money in the bond market, which you don't really have much downside. But if the market crashes, they can make a whole bunch of upside. That is one strategy in a deflationary type movement where you can identify that the housing market's going to crash. You load up on bonds because the downside is very minimal. And if you get a large decrease in interest rates, you make a lot of money to the upside. Those are trades that like Stanley Druckenmiller would take. But for a lot of people, they go into these highly, highly risky companies. They take on all the risk in the world, and then they put their time frame to a very short time frame. You're just setting yourself up to lose money continually. You might as well just give it away to somebody. That's really what it comes down to. What I'm trying to do on the channel here is identify the big trends. There's a couple of big trends. It deals with the business cycle. It's a well-known cycle. The business cycle and the real estate cycle are basically the same thing. And I'm playing the big move, the big 5-10 year move. And we're seeing the large, we'll call it large market imbalances that are coming in commodities. We know that commodities for a fact are cheap in relationship to other assets. So we know the money isn't there, and we want to have the money will eventually rotate into it because it has to. Why is that the case? Because if you take a long enough time frame, if you take 5-10 years plus, we know that there's market imbalances in commodities out in the future where the commodities will not meet the demand. And we can see it in the market balances. And if that is the case, and you have a long enough time frame, your investment is basically a bet on the world expanding and needing those commodities. That's really what it is. Or it's a bet on the world needing more energy than what we're currently consuming because a part of the world is in its S-curve of energy adoption. The world and people innately, there's demand that is innate to human beings. If you were to bring a 2 or 3-year-old into a toy store and you say, hey, look, you can have any toy you want or as many toys as you want. How many do you want? And they're going to start grabbing toys left and right. They're going to grab a whole bunch. The demand is innate. The supply is not. Demand is innate to the person. They want more and more stuff if it's available. The supply is what stops them, or the cost of that, which is a function of how much you make and the supply that's out there. The more the supply, the cheaper that product typically gets. It's not like a flat screen TV comes out and you're like, I don't want a flat screen TV. I want this big box tube that's like 500 pounds. No, people wanted flat screens, but it needed to get to a price level that people could afford it. So the supply was not there, but the demand was always innately there. So we've got people who want to become wealthier. It's going to require more energy and commodities. And the best time to invest in these things or in these trends is when they're cheap. Here's the problem. People have the wrong time frame for this to work. You have to have a long time frame. You have to buy things when they're cheap. If you can't time the short-term markets, as these articles are saying, the short-term movements are difficult to get right. That is the least probability of success. Try your best, get the patterns. Sometimes they don't work. You get your entry points. You botch an entry point. Don't worry, you're buying something that's already cheap. If it goes back down, cost average in. Cost averaging in is a method or a strategy that kind of reduces the volatility in the short term. You're trying to get the best price you can. To buy highly volatile stocks within 50% of the bottom is tough to do. And it's very tough even when you're mid-stride going up because they get these large pullbacks. That is the game. You have to learn the game. You have to be comfortable seeing your account values shift up and down as you go. Commodities are much more volatile than other sectors. A lot of people avoid commodities altogether because of the volatility. That is something you have to learn. The game is what you need to learn. If you don't know the game, you don't know the volatility, you don't know any of these things, you don't know the companies that you own, you don't know the ratios and when these sectors are cheap or expensive, it's going to wear you out. It will beat you. So what I've done is I've created a website which is financial education on how to identify good value. That is basically a ratio driven and market conditions of when those values rotate under certain market conditions where certain assets get priced differently against other assets given certain market conditions. Market condition is something where you have an inflationary period versus a deflationary period. Two different outcomes. Or low inflation, low interest rate environment is very good for stocks. High inflation with increasing interest rates is a different environment. Money rotates differently under those market conditions. And we want to be in the ones that are cheap. Now, if something's cheap and we've got market conditions that are changing, that's your opportunity. That is the opportunity. The larger the imbalance, the larger the market condition can shift, the bigger the opportunity. These bets become very asymmetric, where they have large upside, very small downside. That is how you make copious amounts of money in the markets. Get the correct time frame, get the correct strategy, portfolio allocation size. These all matter. And then you have to be in it for a long period of time, not short-term, low probability movements. Almost everyone loses there. You have to get your time frame right so you can win. So your probabilities of success go way up. That's how you navigate the markets, in my opinion. Doing the short-term trading, again, I've said this multiple times, I don't do it. but I can see that the demand for short-term trading is very high. People think they can beat it. They are inherently gamblers, I guess. But I wanted to create this clip, wanted to get you the statistical probabilities in front of you. I wanted to talk about short-term trading and why I don't do it. I take the longer big picture view, I take the higher probability bet, and I may be buying cheap assets for 3, 4, 5 years. Then I ride it higher. That is how I've made a lot of money. That is how I've repeatedly gotten 10 baggers. You have to buy it when no one else wants it. You have to be standing on your own thoughts, not anyone else. And then you have to ride it forward. The difficult part is, in some of these, is to get a good exit point. Is the oil market done? Is the natural gas market done? Is this recession the top? I don't think it is. I think it's in the middle. I think interest rates go up, and then I think we have another move after it, a big move, because I don't think the market imbalances are fixed. Every time we try to grow, the energy infrastructure isn't in place to extract that amount of energy. It's not already there. We are growing and exceeding the capacity, which will have an imbalance. So whenever we have imbalances in the market, that's where the opportunities are, in my opinion. And I could be wrong. Maybe this recession's a blowout recession and it's going to last longer than what I think. I don't think it is, but it is possible. Again, that's short-term noise. And a lot of these guys, where they've made their money, has been in stocks that control the selling price of their product. So in an environment where you have infinite amount, basically surplus energy, what they did is they chose companies where they could convert a commodity into a usable product. They could control the selling price where they made money, and they invested in those businesses that could grow those businesses. That is where the majority of people have made money. Commodities just amplify your move quicker. You can make more money in shorter periods of time in commodities, but you have to be that much better and that much more disciplined, and the ability to ride through the volatility. It is a more difficult hold, buying and selling commodities. And the commodity equities, especially. I've developed a couple of ways to make lots of money through ratio investing using precious metals, physical precious metals. That has been some of my most rewarding area with the least amount of risk that I have found. And I have that on the website below in the description link if you want to learn about that. The Platinum membership gets you access to everything, and the companies in my portfolio of what I have in my portfolio and companies. And I know people want to be trading in and out. They don't like seeing losses, but that's part of the game. The volatility of things going down in your portfolio is part of the game. You have to learn to deal with it. You're going to have to change yourself. I've got, from my highs, I'm pulled back a lot. I've probably lost more money than most people make in a 10-year time frame in terms of volatility movements. I'm moving big. It's going up and down, up and down. It's part of the game. And I have to be patient, and I have to be emotionally controlled to ride through it. And you have to live your life and be happy at the same time. These things can't destroy you. You have to be focused and say, I know this is coming. I know that there's going to be 50, 60, 70% pullbacks from the bottom that I purchased. It'll go up, and then it'll potentially move back down quite dramatically. Are the fundamentals intact? Do we have growing populations, growing energy needs? And are those energy needs being met? If the answer is no, you have an investment opportunity. And that's where I'm mainly invested. And I've got a large precious metals ratio investing. I call it ratio investing game, where you swap metals at certain ratios and increase your number of ounces. It's pretty primitive. When it hits a certain ratio, you start to transfer over. As long as the trend's broken, that's what I use, basically a big trend. If it's still in the trend and it's going up or down, I won't sell it until the trend is broken, then I rotate over. These things you don't trade very often. Maybe once every couple of years. You might be holding on to something for 10 years. You might be cost averaging into something for 3, 4, 5, 6 years. If it's cheap, the time frames are a lot longer. You put a lot more money into it and you ride it. That is the strategies that I've come up with the highest statistical probability of success. and you're going to have to be patient and learn it. That's how you make money. All right, guys, I'll end it there. Give me a thumb up for the content. Subscribe to the channel if you haven't. And we'll catch you next time. This is Finding Value.